I apologize for the recent hiatus. I am fully engaged, fully watching what's going on in the market. Just yesterday and today, around this time, around 3 o'clock, I'm helping my friend move into his new, beautiful house. Here, can I switch it? I don't think I can switch it. But we got some nice water views. It's a great house in Austin, Texas. So markets, we look like we have bottomed. Friday, we had a very low low. It seemed to be the low for the year. We had 4 out of 9 days closing below, or trading below 3,900. None of those 4 out of 9 days we closed below 3,900, and now we're back above 4,000. I think psychologically that's important, but in order to see a real confirmed bounce, we obviously have to see more than 2 or 3 days of significant rally. So I like what I'm seeing. I like that growth stocks did not bottom last Friday, but bottom before. That's very reminiscent of what I remember from the March 2020 bottom, when the highest intensity growth stocks bottomed several days before the actual absolute market bottom. Seems like there's some similarities with that. I'm not drawing any hardcore conclusions. As for company-specific things, I just saw Ulta Beauty, like Nordstrom, like Macy's, like some other companies, raised their guidance for the rest of the year. Okay, economic slowdown, I get it. Ulta Beauty, Nordstrom. These are companies that cater to stronger consumers, but what's important is that companies like Target, which first of all mentioned that the consumer isn't weakening and the consumer remains strong, are more pandemic beneficiaries. If you look at their stocks, they did very well because of the pandemic, not just because the entire market went up. Same thing with Amazon. Amazon did very well because of the pandemic, and there's a lot of drama around them shrinking their warehouse. But guess what? People are ordering goods less often. When people were locked in their houses, Amazon grew as a business massively. Demand for using Amazon grew massively. Now we are not so much locked in our houses. We are free, et cetera, et cetera, et cetera. And just spending is shifting. So I think we have to be comfortable with the fact that it's not necessarily that spending is contracting, but that specific spending in different areas of the market and of the economy is shifting. And we just have to be conscious of that. And I think if we are conscious of that, we can benefit. I think Ulta Beauty's increased rest of year guidance bodes very well for Smile Direct Club. I've mentioned Smile Direct Club on here. They were hurt because people were locked in homes, not spending so much on beauty products. Well, now we're seeing a reversal of that trend. So we have to focus on different reversals of different trends and these kinds of things, and price earnings multiples, and not get too caught up in Snapchat or Target or Walmart, because while there are some losers as the economy adapts, there are some winners. We had a very good bond auction today. We had the Fed say that we might pause September. I think the dramatic rate picture, the limitless, sky's the limit, rate hikes is not going to occur. We're seeing signs that inflation is peaking. Yes, energy is still hot, but used car sales, which was a massive part of CPI, rolling over. Goods starting to price in some savings. I'm even seeing savings at the grocery store, which is hard to believe. So I think we hopefully are seeing a peak in inflation. And if we see a month-on-month decline in inflation, you best believe the Fed has done its job. It has gotten inflation and inflation expectations down, and things are going to be okay. So that's today's video. Short and sweet. We're keeping it that way for now. We will be back possibly tomorrow in the studio. If not tomorrow, definitely on Monday. So that's today's video. And until next time, peace out.